First place I'd like to start, we were just talking about, you have a pretty interesting background. Tell us a little bit about yourself and tell us about 212 Strategy and what you guys do.
Yeah. Thank you, Dennis. It's great to be able to jump on with you, and thanks for the invitation with Trellis to do this. But yeah, a little bit about me. Originally from the northern Indiana region. Grew up in a small dairy farming town. Between South Bend, Indiana, and Fort Wayne. From there, I went to university down in Marion, Indiana, where I studied mathematics and physics. Always been fascinated on the math front. I know we're talking about that a little bit, but very much been interested in numbers from the very beginning. From university, I was a collegiate athlete there, won a national championship back in 2008. Was fortunate enough to get inducted into the Hall of Fame in 2019.
What sport? Wait a minute.
I played men's soccer. Always loved sports. My parents were both really good athletes, all through high school. So I was a 4-sport athlete in high school, and then stuck with soccer. I'm a Liverpool fan. It can be tough at times being a Liverpool fan, but right now it's we've been doing quite well, and just grew up with a lot of passion for the sport, and especially for that team. So after university, years later, I ended up getting to live in London, which was great. And got to attend a lot of BPL matches and Champions League matches, which was checking off the bucket list. Seeing some of my childhood stars play was pretty phenomenal. But so after university, I ended up doing some traveling. I lived in East Africa for a little bit, as well as in Istanbul, Turkey, and as I mentioned, ended up in Europe for a little while. And in that experience, I ended up going back to school and studying audiology and becoming a hearing care practitioner in the medical field, which was quite an experience. I ran medical offices in Kansas City for several years. And from there, really got into the private equity, investment banking, venture capital world. And that's what I've been doing now for the last 10, 12 years. Out of that, was invited into a firm here where I'm based out of, which is Colorado Springs now. With my wife and kids. I've got a 4-year-old little boy turning 5 and a 2-year-old little girl turning 3. So it keeps me on my toes. But yeah, really got into more of the finance space pretty heavily, working with a firm here based out of Colorado Springs called Centerpoint Partners, which I've been working with now for the better part of a decade. And then out of that is where I launched a 212 Strategy, which was combining a lot of the things I was seeing in the private equity world, whether that was larger companies looking for growth capital, or whether that was startups, looking for their initial seed capital, really finding myself as an executive consultant, working with them on the numbers side, creating value, working with their chief revenue officers on how to create growth and expand. And then really utilizing the banking knowledge that I've acquired in a professional capacity, as well as just having really great mentors. Because I believe every business is two businesses. It's the business they're in, and it's the business of banking. You could probably argue there's a third business in there called marketing. Every company has to market and move their product or their service. But those are the two things I've really focused on, is the business development side, and really being able to help, whether it's a startup or a seasoned corporation, find those different value propositions, to really growth hack their product, their service, et cetera. I've just loved being in the private equity space. Seeing the emergence of the market and how everything is moving, in my opinion, at a pretty aggressive rate in a number of different verticals, both on the investor side and the issuer side. There's a really unique juxtaposition that's happening in connecting those relationships. I know we talked about this a little bit, in the past as well, but it has been quite an analog industry, right? It's been pretty mainframed. In that sense for the last, I'd say 34 years. And we're starting to see a pretty big shift over the last 3 or 4.
What are you seeing what's really changed, as you said, over the last 3 to 4 years? Is it just the advancement of technology? Is it COVID expediting that advancement that might have taken? Is it a little of both, or something that I'm not thinking of?
Yeah. I think it's a combination of those things, and a few others. I think COVID was an accelerant. I joke, but I wish I would have bought Zoom stock, 6 months prior. Still was able to jump on that train, just maybe not as early as I would have liked to. Things like that, creating, really, I think, emphasizing the decentralization of business, and really creating a distributed economy, right? Most of what we've seen up until this point has been centralized. especially in finance, right, with regulators and commercial banks and venture capital funds. I would note that as more of a centralized model. I think it's becoming decentralized in the sense of we're seeing, the rise of crowdfunding. That's been on a pretty solid ticker, I would say, for the last 7 or 8 years. And so in the private equity world, we've been a little bit slower, I think, in adjusting. But what we're seeing is a lot of companies who are looking for capital are being quite creative with that crowdfunding. A non-accredited investor being able to participate with that, it's wonderful in that now, things like, Robinhood, as an example, as an application, now gives the everyday person an ability to basically micro invest, right? Or to have a level of participation. And that's great for the individual. But then looking at it from the issuer side or the business side, that can create a lot of complexity. You've served on a lot of boards, Dennis, and on your fair share of companies as well. It can be challenging to have to report all of that, right? And you're grateful for the capital infusion to grow the business, but there's always that opportunity cost, right? Of how do you manage all of that? How do you manage those relationships? How do you keep those, quote unquote, investors happy? How do you manage that relationship? And that's a lot of what I've done, is that relationship management side, right? Between a capital partner and a business owner, as an example. And so where I see this moving and some of the effects of that, especially with the rise of Web3, is now you can authenticate that, right? Now it's not this subjective thing of this elongated due diligence process to find out who this capital partner is. You can authenticate that on the blockchain, and it's effectively irrevocable. I know some could challenge that to a very large extent compared to what we've had in the past. It's irrevocable in the sense of you do have a blockchain mechanism that is, conferring that data. Are they accredited? You can send in the tax returns, right? There are ways that you could systematically approve that capital partner. That because of the technology, we're able to do that in a much more efficient and effective manner, right? Where we didn't have that before. We had punch cards, and then we had, contracts and ledgers and paperwork. And so now that we have these, digital assets, these digital contracts, these digital ledgers that we can verify that are encrypted, it's had a massive impact in the industry.
So let's talk a little bit more about Web3 and blockchain and decentralized ledgers. We offer that as a service, and I'm still trying to get my arms around understanding all of its functionality and capabilities. And I live in that world. I think as we've talked about this, we're taking a analog business into a digital analog industry into a digital industry, and moving fast and furious with emerging technology here. What is the blockchain? How does it work? How will it impact businesses with cap tables, with record management, et cetera, from there?
Yeah, that's a really good question. The simplest word is efficiency. It will create efficiency and is creating efficiency in what I would call the sales cycle. Sales cycle meaning if I'm a company, and I'm raising $50 million in a Series A or Series B, rather than having to reach out to a broker at a particular firm or a fund, and then they shop it, right? You would typically supply all of those documents, right? Your pro forma, your cap table, your business plan, et cetera, et cetera. And, you're going to go back and forth. You're going to have meetings via Zoom or in person, and you're going to go back and forth, and then you're going to look at term sheets. And so it's this very antiquated back and forth process traditionally. And so where blockchain comes in my mind, and what I've seen, especially working with Trellis now with you guys for the last little while now, is the simplification of I can upload all of my documents into one portal, right? One website, one web-based platform where that can then go back and forth. But I'm not having to send documents, right? I'm not sending emails with PDFs and Excel spreadsheets and all of this. I have one centralized location that allows me to do that. The decentralized aspect is rather than me working with one particular firm or fund, I now have access to hundreds or thousands of potential capital partners or investors that are accredited, right? That registered, that those credentials are validated. You can get into the nuts and bolts on that, but their KYC, right? They know their client customer protocol with the bank has been done appropriately. And so now it streamlines all of that to where I now have a link, right? I can send that out to the relationships I have personally for the, for my business and the capital I'm trying to raise. And, or I can use something like Trellis as an example, that it has its own network of investors and capital partners that it can also push and promote that to, right? And so now you have this very efficacious relationship where the investor isn't spending a bunch of their time. They're getting prompt based on their interest level, right? Not all funds invest in the same particular verticals or categories. And so let's say I'm raising money for a film project, right? I have a production company. I'm looking to launch a new film. Let's say it's on the animated side, right? I'm looking to push and promote this, to raise capital for my production. The film industry, similarly has been quite antiquated. It's a pretty old school way of doing things. And so again, now I can promote this to hundreds of different participants really at the click of a mouse, rather than having this, again, very slow moving process of sending documents back and forth. And so in that way, the blockchain is what allows that function to happen. So that's where, again, I think the technology accelerates the ability to put deals in front of investors, and in turn for investors to field those potential opportunities. And as a business owner, whether that's a startup or, Fortune 500, you have the ability to put your raise, your ask on the platform, and you can submit that to, as many capital partners as you want with a full level of due diligence and security.
It's interesting because, we're talking about decentralized, but the way you said it, part of with modern technology, we put everything into one central location so that we can store it, manage it, record it, but then we can push it out, the ability to distribute it with technology to a larger audience. And I think then tying back in, and then as records are done, transactions are completed on a platform, being able to hash those onto a blockchain, such as Ethereum or something else from there, to create the immutability of the record of the transaction. And particularly as you go forward long term, working with a cap, what's the greatest challenge and the greatest expense getting ready for an IPO, or even in today's new world, secondary trading is these companies have to validate the cap table and go through all those records. So if you can get immutability early on, it should make that diligence process from the investment bankers so much easier in the long term throughout. So it's funny because we talk about decentralized, but the first step is you got to centralize everything to get it decentralized.
Yeah, I think it's, you're in a way, you're distinguishing those different parts so that you can more, that you can properly relate them. So it's centralized, decentralized, and then, distributed. And I think what we're seeing is a convergence of those different practices or ideologies, where you're right in that sense of you're able to put all of your data into one place, and then you can distribute it very effectively, across multiple relationships simultaneously. Prior to, again, it was very much a one-to-one transaction. So yeah, it's a very powerful tool and mechanism. I think, being able to utilize blockchain technology because of what you just mentioned, and you obviously have a legal background as well. It's very helpful, I think, to be able to authenticate that stuff, even from a legal standpoint. Yes, the numbers, right? We want to make sure those are correct, but the term sheets, right, and the agreements and the stock options, is it common? Is it preferred? All that stuff has to be buttoned up legally to make it a qualified transaction.
Now, putting on your marketing hat, still, what do you see as technology has advanced rapidly over the last 4 years, and going back to our original theme of analog to digital industry? What do you see as the challenges of having technology more and more accepted, particularly old people like me who are doing these things that, as you said, for 30 years one way, and now new technologies coming in. How do you get that message out? How do you change people's mindsets and get a comfort level to work with such emerging technology?
Yeah, it's again, simplest term is probably education in this regard. Simple, but not simplistic. The powers that be and how things have functioned has really been built on relationship. especially in I would say the money business, whether that's venture capital, private equity, banking, you name it. That's changed a lot with technology. And, again, differing opinions on that. But I think the challenge is, moving, which is one of the biggest challenges in tech, is migration, right? That's why your cell phone provider will pay you money or give you a new phone to switch services, right? It's an incredibly expensive thing, difficult thing, because we attach ourselves to those brands, right? We attach ourselves to those networks, to those systems. And so with this technology, although I think the technology presents a very unique opportunity within this industry in general, where a rising tide raises all ships. From a marketing standpoint, it is both marketing to those respective, let's say, VC funds or private equity firms or, family offices, but it's also educating them on these capabilities and being able then to implement those systems. And so I think that's one of the biggest challenges. It takes time. It takes time for people to migrate and move over. I think that's happening at an accelerated rate. Just like technology, it used to be, Moore's law was, every 24 months, it would double. And now it's like every 2 months, probably 4 months. But it's off the chart, it's astronomical. And then as well, when we see the rise of the internet, as an example, for me, it was a couple of years ago, I didn't even realize this, but it's upwards of, okay, I'll just be conservative and say it's 20%. It's probably closer to 30 that actually don't have, as far as global population, that still don't have access to the internet, insurance, or banking. You're talking, well over 1 billion people, globally. And so that's going to have a significant impact, right, in the market over time. Again, as this technology is becoming more and more readily available, more and more inexpensive, it's going to have a greater and greater impact. But I do believe one of the biggest challenges is that migration factor.
Yeah, it's an interesting point you have there, and I hadn't thought about it fully. I was at a talk a few weeks ago with a MIT professor on artificial intelligence, and one of the things, the advancements in technology that in the U.S., we went through, copper wire to fiber optics and, wireless now, and built that whole wired infrastructure multiple times over. And he was commenting that in Africa, they went from nothing to wireless. They never went through the steps of of building out infrastructure because there was no need to. It was easier to step. Telephones went straight to cellular as opposed to hardwired lines. Getting
Right.
into buildings and facilities didn't run CAD 5, CAD 6 wiring throughout, just switched right to wireless and bypassed it, which accelerated their development of functionality. And I think you bring up an interesting point with, 30% of the global world. They don't have to go through all of the iterations that we went through. They can go from here to here in one jump. And we're seeing that with Starlink from Elon Musk's company, bringing,
Right.
internet and broadband speeds to rural and
Yeah. I mean, in a few
very
years,
rural areas.
yeah, something like Starlink in a few years, you'll be able to have, 50, 100 megabyte upload speed in the middle of the Atlantic,
Yeah.
things that seemed unobtainable, even 10 years ago.
Yeah.
So it really is accelerating at a pretty good clip.
And that's going to bring back into the financial services world, opening up emerging markets even more and bring in new users that will go from 0 to, 100 miles an hour with modern technology and this functionality so we don't have to worry about them learning the analog way first. They're going to go from 0 to digital, which is fascinating.
Yeah, I would agree. I think we're seeing that as well. I mean, with what Trellis is doing, as well as just the overall rise of fintech, right? If we look at financial technology companies, even in the last 5 years, let's just take it from 2018, I mean, growth at an astronomical rate. Even the large financial institutions, like JP Morgan, are implementing billions of dollars in investment into the financial technology company or industry rather. And I think that's not going to slow down because I see it diversifying more and more. I think what was, formerly traditional, again, is being distributed, is being decentralized right now. How many payment apps do you have? You've got Cash App and Venmo and Plaid and Clover and, it just on and on. And similarly, like with streaming services and entertainment and content, I think we're going to continue to see that hard trend in those directions, especially in financial technology.
So it is kind of fascinating thinking all the way through there and getting in. I wanted to go back to the idea you mentioned earlier on crowdfunding. 'Cause I think that I'd love to get your thoughts on it. I think crowdfunding has also helped speed up this process where the traditional method was if you're a high net worth individual, let's just say you had $1 million, you might put 500,000 each into two funds, fund of funds, who then from there they invest into venture capital funds, who then invest into individual companies, and it was following that cycle through, and you're obviously paying fees along the way. I think there's a demand now where I can go out to an Angel List, Republic, one of these other crowdfunding sites, and invest small dollars as an unaccredited investor into companies and pick and choose and get involved in and track these companies. And then the problem then comes though, is I get capped out at some point because now they go into another round and it's no longer taking crowdfunding.
Right.
As a high net worth individual accredited investor, we can really drive. You get to have say and choice now. You can almost build your own portfolios. You can still do it the other way, much like working in the public markets, but you really can start to create your own fund structures for yourself. I think we also see that in the rise of family offices. Is this just me looking at things, or do you see similar?
No, I mean, in my mind, Dennis, I think you're hitting the nail on the head. Yeah, absolutely. I think whether it's a family office, whether it's crowdfunding, whether it's something like Trellis, which gives you, both and, along with accreditation, I think it's that rising tide that's raising all ships. They have their different function in the market. I think though, where, crowdfunding has definitely filled a vacuum. It's created a new vacuum on the side of high net worth individuals or accredited investors who are looking, for another layer or level of control, of due diligence, and increased participation. I think part of the emergence of this as well is because of the decline that we're seeing right now in the public market, to be very candid. I think people are moving their money out of the market, and for good reason, for a number of different factors. Not that I'm a financial advisor by any means, but
Put that caveat out there for our legal disclaimer. Make sure.
But again, speaking from my own experience, I'm seeing quite a bit of this, even with guys who have worked, in some pretty, prolific companies who, stacked their 401, let's say for, 20, 30 years, are looking at self-directing those 401ks and self-directing those IRAs into these alternative asset classes to have a stake, to have ownership in a performing business versus just being a shareholder, in a publicly traded company. And so that's been very interesting to see. I think because of that as well, there's more cash available, more liquidity available in the market to participate in the private equity world, to be able to have a front seat to these emerging markets and these new companies. And people want to be a part of that for a number of reasons. And so I think, where we see crowdfunding was really and it's still in a pretty good growth. I think it's created this need though for something like Trellis and others where you can, participate as an accredited investor and not only as a participant in a crowdfunding, campaign. It's both and. I think though I don't see them as competing against each other. I think they're actually quite collaborative in many ways. And again, it's broadening the market. Thank goodness for crowdfunding. Didn't have that before, right? There was no option in that regard, and that's had a massive impact in the market. And I think what we're seeing though is we're wanting a little more regulation, a little more structure. To your point, to field those opportunities, to be able to continue to participate as well, because on a lot of those they do cap out. And so you're kind of capped out at the early stage. You don't even get to really participate in the growth funding. Yeah. And things like Trellis help bring a solution to that, where, all right, well, maybe I don't want the early stage startup. Maybe I want the guys who are in their Series B round who are raising 25 million or 50 million, and I want to throw a $500,000 at it. Or I want to do a convertible note. Maybe I don't have the same risk tolerance to just take a straight, equity position in a crowdfunding, startup. Maybe I want convertible debt because I don't know what the valuation of the company is going to be down the road. And so we're seeing some different derivatives now being created with different capabilities that again weren't there even just a couple of years ago.
Yeah, no, great. I do want to get, we're coming up on the end of our time. So I'll let our listeners, our audience know that if you have any questions, please throw it in the Q&A or chat. Love to get those in front of Tyler. I do want to talk a little bit about venture capital, as you do spend a lot of your time working with them. And when we originally planned this, the venture capital world was still very aggressive. Valuations were very high. And as we have come into this, it seems like that has changed dramatically. Is that real? Are you seeing, what are you seeing out there with VCs? Are they holding back? Are they pulling back? Are they still aggressive? What's your thoughts?
Yeah, thank you. What I'm seeing, Dennis, is I think they have pulled back and they're being a little more scrupulous, as are the banks. And I think the reason for that is we're dealing with an inflated market, inflated valuations, and some of that needs to be normalized. Again, that doesn't happen overnight. It's taken years, I think, of progression within the markets and in the way that VCs have been looking at opportunities that has gotten us to this point. But, I look back at, just a couple of years ago with what happened with WeWork, and, here a company that had no hard assets, was really a platform, a service platform that was signing 15 and 20-year leases, through SoftBank and its relationships, gets up to a $40 billion valuation. And I think everybody looks and scratches their head, at how that came to be. And I just use it as an example of that wasn't just a one-off thing, right?
Yeah.
You can't just put that in isolation and say, that happened, but that didn't affect anything else. That had a strong impetus, in my opinion, in how companies were being evaluated in the VC side. And I think what's becoming a shift in my mind is capital partners, VCs alike, are really wanting to see cash flowing companies. Businesses, we talk about cash is king, a lot in the money business. But I think what we're seeing is a little bit of a shift where cash flow is king. Do you have real customers that you're providing a real service for, or a real product that's creating an actual yield or ROI? We've seen this really, the bubble get bursted on several of these, let's say, NFT communities, where they've created a community, they've created a certain level of value on the front end, but it's not attached to a actual performing utility on the other end of the transaction, and that's created some instability. Now, I say that even from a VC side, but at the same time, you can take a large company, one of the largest, like Visa, and Visa just not too long ago purchased their own NFT as a CryptoPunk. And so whether it's the big banks or it's venture capital, I think we're seeing this adjustment now where cash flow is becoming the impetus of value, where the equity, the valuation, that's not carrying as much weight as it did even 18 months ago.
So what does that mean for a recent founder, a new founder who is, trying to raise capital going on? So early stage, should they be looking in different places than traditional VC, seed groups? Should they change their focus? What are your thoughts? I don't think there's really a right answer or an easy answer out there.
Yeah. I mean, in my mind, I'm quite duplicitous in how I approach things, in that, whether it's 7 streams of revenue, 7 streams of income, I would say aim for 10 as a new founder and business owner, because you might end up with 3 or 4 solid ones, to be honest.
Yeah.
But I think taking the same approach, in my mind, as things have shifted on the capital raising side, not putting all your eggs in one basket. And what most people don't understand is, if you're working only with, let's say, one particular firm or fund or one particular broker, you've put your eggs in one basket. Whether or not they're fielding that out to multiple sources, in the same way, like the market, you can say I'm diversified in the market, but you're still in the market. And so there's layers and levels to that. So I in my opinion, and people can take that for what it's worth, I would say there's a unique opportunity to actually divest in your capital raising approach. I think if I'm starting a company today, one of the major things I could look at is how to create value, not just the product, not just the service, but to create value for my said client or customer, create value for them, not just when they're buying from me or not just when I'm servicing them, but how can I create value? How can I create revenue when they're not engaging with my particular product? And again, taking that approach to the VC side of, I think in that regard, companies have a unique opportunity to divest amongst capital partners in a way that they didn't have before. Now you have crowdfunding, now you have accredited investors, now you have family offices and networks of family offices. And so there's a whole platitude of ways that you could retain that capital. But that would probably be a longer conversation for another day to really drill into the weeds on that one.
No, that's great.
Yeah.
And we are coming up on the end of our time here. This is a really good conversation. Where do you think the technology is going to take the private security market over the next 12 months to, up to 5 years?
That's a really good question. That's a challenging one to forecast. Even the Fed right now probably wouldn't even track the dollar beyond 8 to 13 months, right, in value. So, but if I had a crystal ball, to telegraph that, I think there's a really fair opportunity that we'll see the private market, I think in many ways, even from a volume standpoint, continue to increase with I don't know the exact number, but a multiple. I'd say probably anywhere from 3 to 5x, where at the same time, I think the public market, at least for the foreseeable, if you said the next, year to year and a half, I think we're going to see that on a decline. It will fluctuate, but looking at the powers that be, and again, how the Fed is managing that and how the Treasury is managing that. Again, there's different, views and opinions on that. But I think with what's happened in the last 18 months, what's happening now, and then again with midterm primaries and things that are going to happen, I think we're going to see a massive rise in the private market and a pretty steady decline in the public would be my guess. I know there's a lot of different thoughts out there as far as markets crashing and all that. I really don't see that. I think that we have leaders in positions that in systems that are built. I think we've learned our lesson from 2008. I think there's different things in place that we didn't have. So I don't see it as being a devastating crash in that regard. I see it as more of a steady decline, a bear market, where I see the private equity as more of a bull market that's moving at a pretty good pace.
And in that private, what you see is the private side bull market. Is that the concern for, or maybe it's not a concern, the impact to the capital seeker, the issuer, is just lower valuations. Don't expect those ridiculous valuations. You got to give up a little more equity or sell it at a lower price and make sure you plan enough time to build value, as you said.
Yeah, I think it is that. I think it's been inflated. Even that, there's just also the market is growing and expanding. I won't say it's saturated, but you look at a SaaS company, they've been getting 10, 12, 15x valuations, based on their users and their revenue. And I think that there's a wrestle over that right now, as far as the juxtaposition of what is that true value. That's not like a retail business that's maybe a 2 or 3x multiple. When you look at the multipliers of that valuation, when you really think about the value proposition, what those users represent, yes, data is extremely valuable, but you still have to extrapolate the value from the data. And I think what we're seeing is it's not as efficacious as it was, 10 years ago, and for a number of reasons. So I don't think it's going to be a drastic 50% slash or anything, but I do think in the same way we're seeing the market soften, I think those valuations are going to soften. And if I'm an early stage startup, or if I'm even, Series A, Series B, I think those valuations are going to come in a little bit lighter than what they have in the past.
So expect lighter bull market, lower valuations, and goal is to build value and cash flow. Perfect. Well, excellent. I love it. We probably went over our time just a little bit, but it was a great conversation. I want to thank you so much for joining me today.
Yeah, thank you, Dennis. I really appreciate it. And shameless plug, I am very excited about what Trellis is doing and what you guys are building. And I think you're providing a tremendous solution to the market on both sides. So,
and how do people get in touch with you?
You can email me, Tyler@212strategy.co. That's the best way to get in touch with me. And either myself or one of my team members will get back to you and we can take the conversation further.
Wonderful. Thank you so much. Thanks everyone for joining us.
Thank you, Dennis.